Can small changes really create wealth? Yes. Here's how. Stat: over 70% of millionaires accumulate wealth through steady saving and investing, not big wins. That single stat reframes wealth as a slow, measurable process, not luck. Today, we analyze the rules and give actionable steps you can apply this week. First, define your small steps. Step 1. Automate savings. Move a fixed percent of income into savings or investments immediately. Use 1% increases every month until you reach 10% of income. Numbers matter. Automating $50 a week becomes $2,600 a year. Compound interest turns that into meaningful capital over decades. Second, cut recurring waste. Identify 3 subscriptions or services costing more than $10 monthly. Cancel or renegotiate them. Saving $30 a month is $360 a year. That funds one more monthly investment contribution. Small trims compound into buying power. Third, 1 extra income stream. Start with micro savings matched by micro earnings. Sell unused items. Freelance a single hour per week or monetize a hobby. An extra $100 a month becomes $1,200 a year, which at a 6% return becomes significant in 20 years. Fourth, use tax-advantaged accounts aggressively. Maximize employer matches in retirement accounts first. That's free money and immediate return on your contribution. If an employer offers a 4% match, contribute at least 4%, you secure a guaranteed return equivalent to that match. Fifth, prioritize high-interest debt elimination. The average credit card rate exceeds many safe investment returns. Paying down a 20% interest balance is like earning a 20% risk-free return. Reallocate small extra payments from trimmed subscriptions and micro-earnings to debt snowball or avalanche strategies. Sixth, adopt a monthly review ritual. Track inflows, outflows, and progress toward small goals. A 15-minute monthly session keeps decisions intentional. Use spreadsheets or budgeting apps and set one measurable target each month. Seventh, invest in low-cost index funds and dollar-cost average. Small, regular purchases smooth market volatility and reduce timing risk. For many investors, a diversified low-fee index fund outperforms attempts at market timing. Eighth, mind your asset allocation and rebalance annually. Drift can undermine long-term targets. Rebalancing forces discipline. Sell high, buy low, and keep your risk profile aligned with goals. Ninth, increase savings rates with income growth. When you receive a raise, funnel half of it to savings or investments before lifestyle inflation consumes it. A 3% annual salary raise directed partially into savings compounds faster than the same raise spent. 10th, leverage employer benefits beyond retirement. Use flexible spending accounts, health savings accounts, tuition assistance, or commuter benefits to reduce taxable income and free cash for investing. 11th, build an emergency fund with one simple rule. Cover 3 months of essential expenses. Use automatic transfers from checking to a liquid high-yield savings account until you hit the target. This prevents forced selling during downturns. 12th, practice tax efficiency. Use tax loss harvesting, hold investments long-term, and use accounts with tax advantages. Tax drag erodes returns over decades. Small yearly optimizations add up. 13th, educate incrementally. Spend 10 minutes daily reading reputable finance content or annual reports. Knowledge compounds. Understanding fee differences, tax rules, and asset classes informs better decisions. 14th, apply the 50-30-20 rule with micro adjustments. If necessary, change 50-30-20 by shifting 1% monthly from wants to savings until you hit your target. This gradual change is sustainable and psychologically easier. 15th, focus on margin improvements. Slightly better choices. Packing lunch, buying generic, refinancing a mortgage, increase available capital for investment. Compound those small savings regularly. 16th, set automatic escalators for contributions. Many platforms allow scheduled increases. Set annual or quarterly boosts that align with income growth. Consistent percentage increases outpace sporadic large contributions. 17th, use leverage cautiously for real estate or business, but prioritize cash flow positive opportunities. Small, steady rental income or a profitable side business accelerates net worth without excessive risk. 18th, avoid lifestyle creep through visibility. Track net worth monthly with a simple dashboard. When you see growth numerically, you resist unnecessary spending better than vague goals. 19th, network and negotiate. Regular salary reviews and strategic negotiations deliver measurable income jumps. Prepare data-backed cases and request 3 to 5% increases periodically. These have outsized effects over a career. 20th, maintain low-cost habits around fees. Prefer fee-transparent advisors, index funds, and passive vehicles. Reducing fees from 1% to 0.2% over long horizons can add tens of thousands to your balance. 21st, test micro-investments in skills that increase earning potential. Online courses, coding boot camps, or certifications can be small investments that raise income trajectory. 22nd, automate charitable giving if you prioritize it, then incorporate it into your budget. Planned generosity avoids impulsive overcommitment and keeps savings targets intact. 23rd, protect wealth with insurance and estate basics. Small monthly premiums for disability or term life insurance safeguard momentum. An emergency that wipes out progress is avoidable. 24th, create milestone-based rewards. Celebrate hitting incremental goals to reinforce habits without derailing progress. A modest reward at each milestone keeps motivation high. 25th, model scenarios. Run conservative, moderate, and optimistic projections annually. Seeing how small differences in savings rates change outcomes motivates incremental increases. 26th, capitalize on windfalls strategically. Use bonuses, tax refunds, and inheritances to bolster investments or pay down debt rather than fund lifestyle inflation. 27th, cultivate patience and avoid get-rich schemes. Wealth built by small, consistent steps beats gambling for jackpots. Historical market data supports compounding over time. 28th, delegate when appropriate. Use robo-advisors for low-cost automation or financial planners for complex situations. Delegation costs money but saves mistakes that cost more. 29th, use habit stacking. Tie financial actions to daily routines. Transfer funds right after payday and schedule learning during commutes or breaks. 30th, keep a one-page financial plan. Goals, time horizons, target allocations, and monthly actions. Clarity reduces decision fatigue and accelerates execution. 31st, benchmark against real metrics, not peers. Comparing net worth growth to personal objectives prevents destructive lifestyle competition. 32nd, minimize transactional friction. Consolidate accounts and automate transfers so actions require minimal friction, increasing consistency. 33rd, reframe spending as deferred consumption when investing. Visualize future purchases funded by current savings to resist impulsive spending. 34th, use price anchoring for big purchases. Set a maximum acceptable price and wait 48 hours before buying. Many impulse purchases disappear with time. 35th, maintain a growth mindset. View setbacks as data points and iteratively improve the plan. Wealth building is adaptive. 36th, apply the 1% rule to daily choices. A 1% improvement each day compounds significantly over months and years across decisions. 37th, create guardrails, automatic caps on discretionary spending or category alerts. These thin constraints keep habits aligned with goals. 38th, simplify investment holdings to avoid decision paralysis. A core satellite approach can balance simplicity and targeted opportunities. 39th, plan for liquidity needs. Keep a laddered cash position for known short-term expenses to avoid forced selling at bad times. 40th, practice transparency with partners about financial goals and responsibilities. Shared plans accelerate joint progress and reduce conflict. 41st, use visual progress trackers. Graphs of net worth or savings goals motivate more than abstract targets. 42nd, revisit risk tolerance after major life events and adjust allocations accordingly. Age dependence and career risks change appropriate strategies. 43rd, capture small efficiencies. Use cashback, rewards, and negotiated discounts and channel gains back into investments. 44th, hedge inflation. By owning assets with growth or income potential, stocks, real assets, or businesses rather than cash alone. 45th, avoid market timing after emotional events. Ad hoc reactions often lock in losses. Stick to the plan and rebalance instead. 46th, stagger investment entries for large sums. Use partial investment over weeks to reduce regret and timing risk. 47th, prioritize simplicity over complexity. Complex strategies often generate fees and errors. Basic disciplined investing wins historically. 48th, track time spent per dollar gained on side hustles. Focus on highest ROI activities and sunset low-return tasks. 49th, build accountability. Partner with a friend or advisor and report monthly on commitments and outcomes. 50th, protect identity and financial accounts. Preventing theft is a low-cost way to protect long-term compounding. 51st, revisit subscriptions annually and renegotiate recurring costs like cable, insurance, or phone plans for recurring savings. 52nd, adopt conservative withdrawal rules for retirement planning. Aim for a sustainable percentage like 3 to 4% adjusted for portfolio and goals. 53rd, invest in broad global exposure to reduce country-specific risk while maintaining growth potential. 54th, capture employer stock or equity thoughtfully. Diversify holdings and avoid concentrated positions that risk net worth volatility. 55th, plan major purchases around market cycles only when timing is supported by data, otherwise focus on value and necessity. 56th, maintain cash reserves for opportunities. When markets drop, having deployable capital allows buying at discounted prices. 57th, use simulations to test retirement dates and spending rates. Small changes in rates significantly affect long-term sustainability. 58th, keep financial records organized for efficiency in tax filing and better decision support. 59th, regularly reassess goals. As wealth grows, goals evolve. Update allocations and targets to reflect new aspirations. 60th, summary and action. Wealth is built by repeated small steps. Automate, reduce waste, increase income, invest consistently, and review monthly. Start with 2 actions this week. Automate a small transfer and cancel 1 unnecessary subscription. Repeat these steps for years and compounding will do the rest. Like, follow, and save this plan. Start one small step today and track progress.